Welcome. This is Ralph Bivins, the Ralph Bivins Project. We're here today to talk with Christen Vestal, principal. She handles development at Vigavi Realty, and which is in a really hot sector right now, the industrial sector. And Vigavi's building stuff all over, and that's kind of happening throughout the marketplace. So, welcome, Crystal. How you doing?
Thank you. Doing great. Thanks for having me, Ralph. Appreciate it.
Kristen, we have strong construction right now in the Houston areas. I think it's like 22 million square feet of warehouses being built in industrial properties. That's a lot.
Yeah.
So, what does this mean? Why is it so strong, and where are we going?
Yeah. So, one thing that I've heard some people speculate is that, the reason you're seeing such a high number of square footage under construction is that construction is taking longer. It's taking longer due to supply chain demands. And so product isn't coming online as quickly as it used to. And so that is playing a factor into such high numbers. But on top of that, obviously, we have a skyrocketing absorption. The 12-month absorption is over 30 million right now, and that is just historically bigger than anything we've ever seen. And if you're a developer and you're seeing that absorption, you're seeing how much is actually getting absorbed, how hot leasing activity is. All it does is bolster more and more development, right? So as long as we keep seeing deals getting done, people are going to keep kicking off new projects. I think that's playing a big factor into the number of square footage under construction right now.
When it's going this strong, you would think everybody wants to do one. It's shouldn't be that hard to get a loan. It shouldn't be that hard to be optimistic for sure. And that's one thing we know about developers is they're typically very optimistic. They always think, even if the market's way overbuilt, they'll say, wow, but my project's a little bit different. My project's going to work.
Yeah.
But
our projects really are different.
So what's Vigavi up to right now?
Yeah, so we've got a lot of things in our pipeline. We got a bunch of new projects and land sites we closed on over the last, call it 6 months. We've got 400,000 square foot project, which is our Park 225 project out in Southeast Houston. It's a 400,000 square foot building that's got frontage there on 225, just west of the Beltway. And that's what we call the 225 corridor. And it's one of the only greenfield sites that was available. So we were really excited to be able to win that land site and put that property into production. There's not if you look at just the 225 corridor, the vacancy rate and available property there is extremely, extremely low. And so we feel really great about that. We're planning to deliver at the end of the year in December. And we've got a lot of activity on that project, full building deals that we're looking at in the 400,000 square foot range. So that's our top priority right now. We've got a lot of other smaller projects in and around the city, 100 and 200,000 square foot buildings. We've got a 200,000 square foot building that we have under construction right now. That is a forward sale that's in the North Market off of 1960 and Hardy Toll Road. So we're excited about that. And we feel very lucky to have a forward sale in place that is still proceeding forward, considering the interest rates moving on us during the middle of the project, which did impact a lot of forward sales. So we're still proceeding with that project. So we're excited to, solidify that and not have some hiccups considering where interest rates are moving on us during the project.
Interest rates are skyrocketing. Inflation is skyrocketing. And, I believe we're in a recession. 2 quarters of negative GDP is what we've always defined as recession. Wondering, how long is the overall economy going to deflate things here in Houston?
It's a great question. I think Houston specifically has a lot of headwinds, just considering all of the people moving from California, people rerouting their supply chains to the Port of Houston. If you're talking to anybody at the Port of Houston, they're seeing, we still have 2 to 3 year runway left because they're seeing so many new requirements coming. They're putting a lot of new infrastructure in place to be able to accommodate bigger container ships. And so we have a lot of things working in our favor. Hopefully, considering globally what's going on at a macro level, we'll be less impacted. I think from Houstonians, we always have that opinion that we are less affected by what's happening globally, and we tend to withstand global things here. And we've seen that, right? In Southeast, specifically the Southeast market, that had 46% of the absorption over the first half of this year, or actually in the last quarter, Q2, and that is huge. And I think that really shows the activity from the port and how many people are really rerouting and bringing their materials into the port. To see 46, almost 50% of the absorption happen in that one submarket, that's pretty extraordinary.
Well, you would think that, I know there are a lot of things impacting the supply chain crisis, as they call it, but we do know that, the ports in Southern California, Long Beach, Los Angeles, huge ports for bringing in container ships from China and everything. So that has been notoriously blocked up a lot. So we keep hearing that it's going to someday people are going to say, well, let's just go to Houston and quit trying to unload there. And I think that's going to be a pretty successful growth pocket for this part of the country.
Right.
Houston got a great big port, and we are able to now handle a lot of the container ships better than we used to. And so that seems like a growth thing.
Yeah, the Port of Houston approved their project, what they call Project 11. And so they approved the initial phase, which I believe is around $165 million. And over the next 5 years, they're putting in $2 billion worth of infrastructure there, which is a massive number. And so Houston has really strategically put themselves in a place to be able to benefit from everything that is happening in the supply chain and in California. And we're seeing that. We had a building available for sale in Southeast Houston. We called it our Southeast Crossing project. And it was a 130,000 square foot building. We put it up for sale. We were under contract. I think, about 45 days before we completed the project. In that time period, we had 3 other offers. All of them were from California people moving to Houston, moving their operations and rerouting their supply chains to come into the port. All users out of California, multiple backup offers, and we ultimately did sell it to a user who moved their operations out of Huntington Beach into Houston, a tool company.
Why not bring it here and unload here, and for if you're going to bring everything into Southern California, then you got to get it on a truck or a train and get it across the country. And it would seem to be less expensive to come in here and less, not as cumbersome just to come into Houston. Boom, and you're all halfway across the country, and you can distribute nationally from here. We got the train, got the truck, so hopefully I'll keep the economy going.
That's right. And one thing a lot of people don't realize is that 60% of the nation's population is on the East Coast, up and down the East Coast. And so you are closer to majority of the population coming into the East Coast versus the West Coast.
That's a good thing. And we're here. The other thing that I've heard about is that, so much of our manufacturing has been done overseas, and some people are thinking about that, saying, well, why not bring that back to the lower 48 here and manufacture it here, so there won't be any potential blockage or slow delivery or whatever.
Right.
I think that should help the industrial real estate market in this area.
Yeah, there is a lot of talk about manufacturing companies coming back here and reshoring their manufacturing facilities here. We historically haven't been doing as much manufacturing over call it the last 3 years. Our focus has been in distribution just because it's the tailwinds and there's just such significant requirements right now. So we're not seeing a ton of that, but I do know there's a build-to-suit group here called ARCO, and I know they're working on multiple very large manufacturing facilities that are reshoring here, and so there's a lot of activity there.
That would be good. We need all the we need all the help we can get here.
Right. Yeah.
We will got to maintain our position as a great city and the energy capital of the world. I think we're still called that. And,
yeah.
and you know what? But yeah, I don't know. It's difficult to tell, and but you would think that now oil's been in the 90 to 100 degree, $100 a barrel range for about several months now, and last year it was a lot less in the 60s, and of course it had the crash during the COVID era there. Went to zero, but higher oil prices. What does that do for us?
Well, specifically for us, as far as developers, we were. It wasn't a pleasant surprise for us because we started hearing, okay, commodities are coming down, steel pricing's coming down. We're like, okay, great, maybe we're going to get some relief on our construction pricing, and immediately transportation cost rose significantly, and that just played a factor into, okay, we had steel pricing come down, but now transportation costs went up, and they just offset each other, and so we didn't receive any relief like we thought. And concrete went up 20% also. So, it plays a significant factor in our construction pricing. And we would like to get some relief there and keep hoping that something's going to give on the construction pricing side. And having oil and gas just skyrocket up only further put us in a weaker position as far as construction pricing. So it affected us negatively from that perspective. Now, we're in Houston, Texas, where higher oil prices always seems to help bolster our economy and drive activity here. And so, hopefully we're seeing some response to that as far as tenants in the market and driving activity and leasing activity.
I think we've, there has been a reluctance to for energy to really spread their wings and start high production. Although I think some of the smaller firms are getting into it, so this could be better. But you would think that sooner or later the demand's going to be there, and these guys are going to want to drill more, build more drill bits and things of that nature, thread more pipe, whatever they do over there with those heavy manufacturing buildings.
Yeah, and we are seeing the activity as far as the 3PLs. They support the oil and gas industry, and two of the highest uses in warehouses right now, the requirements are e-commerce tenants and 3PLs. And you're seeing a ton of new 3PLs coming to the market that are supporting the oil and gas industry. So we are seeing that in the tenant activity.
That's great, man. That's great. Okay, well, you mentioned that about the dominance right now of the Southeast market, which of course is near the Port of Houston and all that. But what about other parts of town, other sub-markets, as we might call them? What are you hearing or seeing in other parts of town?
Yeah, so historically in Houston, the Northwest market and the Southeast market always tend to be strong markets, and you're just seeing exponentially strong in those two submarkets right now. All the submarkets are doing good right now. Absorption across the board is great in all of the submarkets. So activity is very good right now, and it's hard to say, this submarket or that submarket. Houston, it's been my experience that the submarkets do operate somewhat independently, and if you have a tenant in the market, they're typically focused in one submarket. However, just because activity is so strong and it's taking longer to get buildings online, tenants are looking, in all submarkets right now. So there's a strong activity in all of them.
As you drive out, some of these places like the Beltway, kind of south, all that. You get on the Beltway 8 or Sam Houston Tollway, kind of south of Hobby Airport, and start going out to along there to Sugar Land. There's a huge amount of construction that's happened and still happening, that's still going on. And the Highway 90, which kind of comes from the south part of the medical center and everything, those areas of this, I drive those and I see a lot of construction.
Yeah, activity in the South Belt has been great. I mean, there's a lot of people that kind of took a bet out there and kind of were the first to the market there, and was a little bit pioneering there, and they've done great. Activity's been good for them. Deals are getting done there, leases are getting done at high rates, and so they took a chance, and I think it's working out well for them. We have a property that we're under construction. It's a smaller building. It's 113,000 square feet. It's off Highway 90 at the Beltway. And we pre-sold that. We were under contract prior to closing on the land. Now looking back, we kind of wish we would have not done that because we think we could have got a much higher price today. But it takes the risk out of it, and it just shows the demand there for user sales and leases. I mean, activity is extremely strong in the Southwest market. Leases are getting done. And we've had multiple people call us on that building. I mean, we still are getting calls every day. Can we put in backup offers? Is there a possibility maybe these people don't close on the building? So, that just tells you there's not a ton of available product, especially on the sales side for purchase. And the user demand to purchase is still there.
That's amazing. I know you're familiar with, the last mile distribution buildings, as they call it, which for people that followed that real closely, it's kind of like for delivery, a lot of consumer delivery. They want to be, close to residential so they can get in and out quickly and deliver to homes and things like that. That's what's going on with the last mile sector.
That's a great question. I was listening to Prologis's last call that they did, and they have their whole executive team on there answering questions. And something interesting that one of the executives noted, because everybody's asking, Prologis has one of or the biggest industrial portfolio across the country, and whatever is happening in their portfolio tends to follow market trends. And so, on the call, people were asking, well, what's going on with Amazon? Are y'all giving back space? Are they subleasing space in y'all's portfolio? And it was interesting what they said. They said at the beginning, we have 132 different facilities that Amazon leases from us. So 132 leases with Amazon. At the beginning of the year, we were talking with them about 2 spaces, just 2, about potentially putting it on the market for sublease. And he said, since there's been no further conversation and not one space has been put on the market for sublease, not one. They have not given back any space. And so I think that's kind of telling that we hadn't seen that kind of what they talked about at the beginning of the year, that they're going to sublease all the space. You haven't seen that happen yet. And so I don't know if they're slow to the market or that they truly do need the space and the demand is there and it was a defensive move. Don't know, but it's interesting that the Prologis execs had that perspective, and they said their locations with Amazon are strategic locations and they're not giving back any space, and they're paying rent and they're using their spaces.
Interesting. Yeah, it's really interesting. That was kind of like a shockwave that came out, the story, I guess, in the first quarter of 22, the story kind of leaked out that Amazon is pulling in its horns. They're going to retreat after they've been this, a monster consumer of
Right.
everywhere. I think they had, 4 million square feet in various places just around the Houston area at one time. It's that under construction, new development, and so the fact that that's just that retreat, Amazon retreat, hasn't panned out. And if anybody would know it, Prologis would.
Right. Right.
That's a good thing, isn't it?
Yeah. That's a great thing.
What about now? We talked a little bit about sites earlier and land and things like that. But you're probably constantly on the prowl for properties that would fit Vigavi's needs and for new construction. So, tell us a little bit about what you're experiencing in the land market.
Yeah. It's tough. Yeah. I mean, we're looking at land sites every week, every day almost. I mean, that is a daily activity for, a speculative developer, right? You're always looking for the next deal. It's tough. It is extremely tough right now because, a lot of land sites were put under contract at really high numbers. And considering where interest rates are right now, those really high purchase price numbers don't work. They can't pencil. You can't get equity for them. And so you're seeing a lot of, especially larger sites being dropped across the city right now. And what you think is, well, that creates a great opportunity for us to go scoop this up and go, scoop in and go behind them and pick it up. Well, the problem is that the land sellers, you've set their expectations so high that it's going to take time for them to get those expectations down, if they ever come back down, or you wait for the market to come and maybe interest rates come back down, or you see lease rates get so high enough that it can support that purchase price. We're not there yet, right? We don't have comps to support those lease rates that can make sense at where some of those numbers, some of that land site was put under contract at really high numbers. You're struggling with, well, what do exit caps look like right now, considering the new interest rate environment? So it is very, very tough. I mean, I had a broker call me up and he said, hey, I was looking at this site. It was under contract by another industrial developer. They dropped it. And their response was, even if we got the dirt for free today, we can't make the numbers work. Even if they had the dirt at zero land basis, they could not make that deal work. And that just there's it's such a constraint in the market right now where interest rates are and where construction pricing is. If you get the dirt for free, some of these deals can't work, can't pencil.
That's serious. Maybe the 20-something million we have under construction now will be the end. I know it won't be, but that's tough. That's a tough. And you think the Fed is going to go ahead and do another 0.75% add on to the rates when they come back again in a couple months. You wonder when is enough, but it seems like they think that's the only way to curtail inflation.
Right. I mean, we're underwriting deals right now at land values that we were purchasing land at in 2014 and 13 and 14 land prices, which we haven't seen in years. And it's still a struggle to make land prices at that price work. And that was, years ago, land price numbers. So we keep hoping, fingers crossed, that you're going to see construction pricing come down significantly to where it can help bolster these new projects, but we're not seeing it yet.
Well, that's a scary thing on the horizon. And I think back to one of the last crashes, and it seemed like that the Federal Reserve was just relentless in raising. They wouldn't stop. They just kept banging it, and you felt like, hey, we've got it where we want it. can you guys,
Stop.
yeah, just tap it a little bit, that would help a lot.
And so what did you see in the market when that happened? They just kept raising rates and raising rates. I mean, what happened to activity?
It was bad, this was bad. And, it affected everything. Home sales, of course, that hurt. They were hurt, and that hurts everything. And I don't know. I don't want to go there again. I hope this is just going to be a light and easy recession. Not, but we've been through several cycles. We can do another one, but
Yeah.
it's going to be
I've
tough.
been, I started my career in the industry in 2012, so I haven't been through significant downturns, hoping not to see one. But, I've heard horror stories, especially from, older peers and older, the kind of older generation telling me about what happened in the 80s and how that's really kind of, it slows their growth and what they pursue and things like that. So it's interesting dynamics to hear.
The 80s was really, really bad. We lost hundreds of thousands of jobs, and oil was down at $10 a barrel and stayed there. Just majorly, and to top it all off, we'd had this big surge before that with major amount of construction financed through S&L, some of that stuff that was not necessarily based on fundamentals, so that we amassed this huge amount in every kind of real estate, a huge amount of overbuilding, and so
Wow.
oil crashed, the banks crashed, and so that was pretty deep when it took a long, but there were buying opportunities, for on all levels. People that could flip houses, they could go out and buy a foreclosed 322 for $25,000, rent it out.
Wow.
People made wealth that way. So there's always opportunity for somebody that's has the courage and is thinking about it and has the right plan. But it can be painful, and a lot of people get hurt on the way down. I hope we don't go there. But
I think you hit the nail on the head with
what?
I was just gonna say, I think you hit the nail on the head with the fundamentals, right? I mean, in a frothy market, it's very hard to kind of constrain yourself and make sure, hey, let's stick to the market fundamentals. Let's not go get crazy, and let's not pay a high price for land prices when right today it doesn't pencil. We're trying to trend rents, and so if you stick to your fundamentals and you be, conservative, I think it kind of help you get through some of these times. We've been fortunate that we did stick to our fundamentals, and we didn't go out and compete on deals where we thought it would be very hard to pencil and make those things underwrite. And so that's put us in a good position today that we're still able to move forward on the projects that we have under contract and in place, and we didn't have to drop any land sites due to moving our fundamentals and not being kind of a strategic, developer.
Yeah, that's good thinking. I think you're going to be around for a while. I think you're going to be a force in the marketplace for quite a while here. So,
Well, thank you, Ralph. Appreciate that.
After some of us have headed for the house, but it's great to have you, Christen. We just brought the fresh air, and you've got a lot of experience already in your career. So we interested to see what you do with Vigavi Realty, but thanks a lot for taking time to be with us, and we will have you back someday, and we'll see how it all turned out.
Yeah. Well, thank you, Ralph.